Hi, Dr. Candace.
Good evening. How are you?
Just good.
Good. I heard you all talking about March birthdays. My birthday's in March too.
What's the what?
No, they were talking about February.
Oh, okay. Okay.
I think it's
Pisces.
Jennifer and my daughter has the same birthday.
I see. Okay.
I have the same
We-
birthday as well.
We are live. You just get the recording going here.
Okay.
Hi, Louis.
Hello.
One of the co-chairs want to get us started here. I know Christina, I think, was probably not going to join.
She's not gonna join. Okay. It's
Welcome.
Kim,
Al here.
yeah,
Okay.
both here.
We'd like to
Thanks.
get our investment committee meeting today, February the 19th. Started today. Can I get a roll call vote?
Christina Bennett. Candace Carter Oliver.
Present.
Louis Cross.
Present.
Mary Donaldson.
Present.
William Heisey.
Present.
Emily Hubbard. Kimberly Johnson.
Present.
Shanice Johnson.
Present.
Yvette Levy. Jennifer Orr.
Present.
Albert Sanders.
Present.
Andrew Bean. Doris Walker.
Present.
And Christina Bennett.
Present.
Okay, so we do have 9. We have a quorum.
Oh, great. So who's presenting today, Sue, on our investment meeting? Is it Jeff or Gwelda?
I will go ahead and jump in if you're ready for me. What Gwelda looks like she was having some technical difficulties, so she hopefully will be on at some point.
No problem, Jeff. Thanks and sorry for my tardiness, everyone. Jeff, if you can just please take it over. One additional point of order. Albert, you must have changed your cell number because it bounced back to me, so please send me your new one. Thank you. Thank you, Jeff. It's all yours.
Okay, fantastic. Good afternoon, everyone. So hopefully everyone's ready for some little bit of education. We've invited Westfield, which is one of the system's small cap growth equity managers, to present today, and we did ask them to spend 30 minutes on some general education before they sort of get into their update on the portfolio and what they're doing for the system. So hopefully we can get some education through this presentation, and then also a nice update on their portfolio. So I'll kind of let them walk through everything. But Sue, do we have them in the waiting room?
Yeah, there's 2 of them, Justin and Matt.
Okay.
So I will let them in.
Hi there.
Good afternoon.
Good afternoon.
Hi, everybody. Thanks so much for inviting us in.
Justin, do we have somebody else?
Yeah, I'm sorry. So just introductions. Justin Moscardelli, part of the marketing client service team at Westfield. With me is Matt Renna. Matt is a managing partner. He's a senior member of the investment committee. Both Matt and I are members of the management committee. I'm a partner as well with the firm. And we just really appreciate you inviting us in today.
Fantastic. So Jeff Cookdom with Mariner, we're the investment consultant for the system, and just wanted to I think Gwelda probably gave you a general overview of, we certainly want to get an update on the portfolio and that you're managing for the system, and all the good things that are going on there. But in addition, this group also has ongoing continuing education requirements that can be fulfilled if we have managers such as yourself that just spend some time on not specifics of what you're doing for the system, but going over things like, what is the small cap growth equity market and just basic investment understanding points. So we did ask you all to spend 30 minutes on that today, because that's sort of their minimum for that education requirement, and then you can spend the remainder of the time giving us an update on the firm in general and the portfolio.
Great. Yeah, no, happy to do that. And I hope this will suffice. So again, I'm Justin, and just even before all that, Jeff, too, just, we certainly appreciate this relationship. This relationship dates back 26 years to the year 2000. So that's quite a long time. The firm was founded in 1989. So the fact that you were one of our early or first investors that are still with us today is something that's really important to us. So I certainly do appreciate that. And yeah, if we want to go through what we thought in talking with Mariner was just a little bit on what is small cap, what does it mean, how do managers like ourselves try to approach small cap, and what do the growth benchmarks look like, and what does the benchmark look like for small cap? So we can certainly spend some time trying to educate and go on that part, and then we can pivot and talk a little bit about the portfolio and certainly how it's constructed, and then the most recent performance. I will say one of the other things that we included as part of education, the education piece on this, is that, and I hope this is appropriate, in addition to what is a small cap stock, we're incredibly optimistic about the small cap space. Now, that is not because that's where your investment is and has been with Westfield, but we just see a lot of the headwinds for small cap that have been in place for the past decade have not only started to subside, but have really started to take root since really the end of the summer. And so this is a very good time, we believe, to be invested in this asset class that your money's with Westfield are invested right now. So that's kind of my intro there. But if you want, I'm not sure who's driving here, but maybe go to
Justin, I have your presentation up, so just let me know where and when you want me to advance it.
Yeah, thanks, Susan. That'd be great. If you can go to page 2, that would be great. Oh, sorry, the next page. Yep. And Matt, certainly jump in any place you feel. But one thing we just wanted to provide was just what does a small cap stock mean, right? What does small cap mean? You hear these terms and it's like, okay, I get it, maybe small company, and that really actually is it. I know St. Louis has, and the public school has, a number of different investments across the board, across different capitalization spectrums, across different asset classes. Small cap stocks are really defined by the market cap of the company. So what does that mean? Market cap is really the total dollar value of the shares of a company's outstanding stock, right? So you take the outstanding stock, multiply that by the price of the stock, and that is how you get to a market capitalization of a company, right? And what I would say is smaller capitalization companies fall within the small cap space. Larger cap, obviously, big companies, you've heard a lot of them in the paper, the Apples of the world, the Googles, the Microsoft, those are all reside within the large cap part of the market. But what I would say historically, if you look at market caps, historically, and this is when I first started my career in Westfield, you used to think of small cap stocks as below 6 billion in cap, right? And that was back 2000, early 2000s up until 2010. What's changed is the market has gone up considerably since that time. So the market caps of small cap stocks, what used to be considered maybe 6 billion below, when you hired Westfield, the market caps of the market cap range was probably somewhere between, call it 3 to maybe 7, 8, 10 billion in market cap. Today, the range of the market cap of small cap stocks in the growth benchmark go all the way up to 36. This was as the printing, and this was as of the end of last month, January. But now that's even gone up to 44 billion. Right? Now that's one stock, 44 billion, that's gone up so much in the index that it represents the far end of that index. Now that's not necessarily normal, and we could talk a little bit about the benchmarks in a minute, but the market caps of small caps have accelerated to the point where they're much higher than they were certainly.
Hey, Justin, just to provide some perspective too, can you tell, I mean, it's something that everybody knows, Apple. What's the market capitalization of Apple?
Oh God, you get me on spot here. Trillion, right? Right, Matt? Isn't it
Yeah,
trillion?
over a trillion.
Yeah,
Okay.
it's over $1 trillion. So, and that's a good question, yeah, because when we start to get to why we think small caps are going to do well, you know, the large cap stocks, the Apples, the Metas, this basket of stocks that have been labeled the Mag 7, the Nvidias of the world. If you open up the Wall Street Journal, you put on anything on TV nowadays, right? You probably hear somebody's bought into Nvidia or Apple, and those 7 stocks, those $1 trillion club of Apple, the $1 trillion market caps, have driven so much of the market over the past decade that tide is changing. And it started in the end of the summer, and it's definitely happening here in 2026. And so the small cap stocks that right now, just by the way the benchmark is constructed, are below 42 billion, which that isn't really truly the range we think. We think of small caps anywhere between call it $20 billion and below, right? Let's call it.
I would say, just to add a point there, what Justin's saying, but the reason this matters as a small cap investor is as that market cap has kind of gravitated upwards over the years, the investable universe for small caps is much higher quality today than it was even 5-6 years ago. So back when I first started doing biotech, the companies that were in that $500 million to $1 billion range were just really low quality companies. And now we've got companies that have drugs that are on the market generating real revenues. And so you get real sort of cash flowing, high quality companies now further down market cap.
Yeah. Yeah. The other thing I would say too is the way that Westfield's, well, I know we're not supposed to talk about us, but the way we're constructed, we can buy a stock in your portfolio if it's within the range of that benchmark at initial purchase. So like I said, right now, the highest end of the range is actually a stock in your portfolio, Bloom Energy is a stock that's the highest stock in the Russell 2000 growth benchmark. And it just keeps appreciating higher and higher. What ends up happening is every year in both June and now in December, 2 times a year, the benchmarks reconstitute and they say, okay, these stocks have grown so much that the price of the stock has gone up so much that the market cap now is more reflective of a mid cap stock, a large cap. It graduates out of small cap and into mid cap or large cap. And that's going to happen with Bloom Energy. It's 44 billion in market cap right now, right? But then what happens is they reset the clock, and then the high end of the range typically goes down around 12 billion, call it somewhere around that range for all the stocks that are currently now within the Russell 2000 growth index. But just in terms of small caps, the other thing we put on this page, like what happened? Like small caps, for instance, right now we think provide a really amazing opportunity. And like Matt said, it tends to be an asset class that's maybe it's gotten a little bit higher quality, but it also is an area because there's so many stocks in there. You're going to see on the next page that there's a lot of fish in the pond for us to go after in small cap to try to find good quality companies that might be able to differentiate themselves from their peers. But that comes with a little bit more volatility that you might get from a large cap portfolio. The stocks could, because they're smaller market cap, you get a big buyer in there, you get a big seller in there. Those stocks could fluctuate and vacillate a lot more than maybe you might find within a large cap stock. But there's also a higher maybe upside potential on those stocks, right? You could get a company that appreciates considerably because it's a little bit maybe less liquid. It's a little bit thin from how it's traded. These stocks aren't traded as much as the Apples and the Metas or Googles and Microsofts of the world, right? There's fewer people who are chasing those stocks, so the stock prices move a little bit more than they might in large cap. If you go to the next page, this speaks to a little bit of what Matt said and what we were talking about. So on the right-hand side of the page, you can see that on the top right, so that is the analyst per coverage per stock in the market cap segments, right? So if you look at sell side analysts, basically, so these are firms where we could look to try to give us insight into certain companies. We do our own research, but sometimes we rely on kind of Wall Street sell side analysts to give us consensus. But you can see there are fewer maybe analysts that are covering per segment of the market caps that are covering certain classes, and so you've got fewer analysts tracking on some of these names, but then you've also got more stocks within the benchmarks on the bottom page. So what you see is The Russell 1000 growth is typically around 400, maybe 400 to 450 stocks within the Russell 1000. That's the large cap benchmark. The mid cap growth you can see right now is like 250, I'd call it, stocks. And then the Russell 2000, you see far more names, about 1,000 names within the Russell 1000 growth. So, we believe we're only looking toward in your portfolio, and active managers typically are trying to be concentrated. They look for 60 to 80 stocks within a small cap portfolio, typically. And so you do believe you can find a lot of good value, and you find some good companies, quality companies that you want to put into your clients like St. Louis's portfolio out of those 1,000 stocks, 1,000 plus, right? There's a lot of inefficiency, let's call it, in the market, right? And what we're looking for is to try to find some of those gaps. And what happens is, if you have a lot of companies, and Matt, you could talk about it within biotech. I mean, I hate to say junk, but you have a lot of companies that, we would never say, hey, we want to put St. Louis's constituents and their future and their livelihood and their retirement money into some of these lower quality, call it biotech companies, where it's a coin flip on whether it'll get approved or not. Like, that's very risky. And so staying away from a lot of those companies, I think, has had value over time for St. Louis. But there's a lot of things to consider. Like, when you look for these companies, we want strong balance sheets, or a lot of managers, active managers like Westfield, who have been hired to try to outperform the benchmark. What we're looking for are strong balance sheets, scalable business models. The one thing I would say about small cap companies, because a lot of these companies are maybe it could be in their infancy. They could have been an IPO recently where it just became public. It could be a company where they're 5 years old, 4 years old. There's a lot of things that need to go right for that company, and you really need an experienced and quality management team to help guide that ship, right? And so we often say within small cap, because Westfield does manage portfolios, small cap, mid cap, large cap, up the cap spectrum. In many cases, you'd almost take a B plus product, but an A plus management team, than have the reverse. If you've got a fantastic product, but you don't feel you have that good stewardship by the CFO, the chief executive officer, the head of sales, then that's a company that you can't really trust as much. Now, that's what we're hired to do, is try to ferret that out and say, okay, these are the companies we want to align with a long term, and these are the companies we want to invest in. And that's what we look for on your behalf. And some of that actually is on the next page. So again, I apologize if we're kind of veering a little bit, but just in terms of our process and the fundamental research we do, this is the deep due diligence and these are many managers. You could scratch Westfield off the top of this. I don't think this is inherent to us, but as we learn about small caps, the things that we want to figure out is obviously the things that are included in the bottom, right? That we want to do interviews with management teams. We want to talk to suppliers, competitors, do a detailed up financial modeling, because for us, we want to make sure that there's earnings story behind these companies, earnings growth, because for us, stock prices follow earnings progress. So if a company continues to post compelling earnings, which they have to report quarterly, if a company continues to post earnings that are compelling and above where consensus is, where the street is, that small cap company could do very, very well if the earnings are there. And so that's what we're looking for when we talk to these companies.
I also think one point to add here is just relative to some of our peers that are segmented by market cap. So they're, a small and mid cap growth only manager or a large cap growth only manager, where we have products and responsibilities across the entire market cap range. There's a ton of synergy. So we actually find a lot of our small cap ideas just by doing diligence on some of our larger cap companies. So in my space in healthcare, obviously a pretty big piece of the Russell 2000 small cap index is biotech, right? And so if you can find the right assets in biotech, a lot of times those end up as part of a larger biopharma company. And so how do you really know how these large cap companies are viewing the space, how they think about valuation, what are their portfolio needs and their firepower to do deals, unless you have the formal coverage of those companies and have those relationships. So we're able to talk to the CEO of Eli Lilly and Pfizer and Merck and understand kind of how they're viewing the space. And that, generally speaking, translates, I think, into a higher hit rate on M&A. So in our small cap portfolio last year, I believe we had 5 acquisitions. And so far this year, we just actually had a big one yesterday in our small cap portfolio. So I think having that relationship across the cap range has been really good.
Yep. And then on the next page, that shows a little bit.
Hey, Justin, can I just back up again before we jump into more specifics on your process? But so can you kind of walk us through, because number one, talking about active managers and you again, kind of differentiate what you're doing from there is an index, and again, Russell 2000 index, is that a viable option? Can someone just invest in an index in your space? So number one, that, you know, part of that, and then the second part of that question is we've spent a fair amount of time with this group over the past year with some private equity investments. So kind of talk us about the difference or evolution from, you know, what a private equity is to the space that you're in. And then is there a gap? Because there's a Russell 2000, and then is there sort of a gap between that of available stocks that are public? And again, why this area of the market?
Yeah, so great question. So the indexes were constructed to kind of keep managers like Westfield honest, right? And they really started to take hold. And by that, I'm referring to the index could be any kind of a benchmark that you've hired a manager to outperform. You could have said, we want you to outperform the S&P 500. Well, that becomes the benchmark, right? Which is a collection of 500 of not just the biggest stocks, but kind of the most influential stocks within the market. But what Russell is a firm based in the Pacific Northwest, and they understood back in the 80s, I think it was, 70s and 80s, that we need more specialized benchmark. We need to create more specialized benchmarks that institutional investors like yourself can use as a yardstick to keep their managers honest. But they need to be segmented by either a growth manager like Westfield, who is looking for something like earnings growth, versus a value manager who is looking for companies that have very strong value characteristics, or stocks that have been irrationally, call it, beaten down, and it's a very good buy, irrespective of the fact that they may or may not have good earnings growth. They just think the market has disconnected to the point where this is too good of a value to pass up. So those are very different ways to approach how an investor like Westfield will go after these small cap companies, small cap stocks. And then you've got kind of in the middle, and that's called core. So a lot of times, if you're thinking about the way managers like Westfield talk, and I'm sure what Mariner has brought to you, you've often got growth value in core. Everything that I'm talking about is publicly listed companies, the public markets, right? That is very different from private equity, which is private markets. And so everything we invest in has to have gone through the regulatory process of an initial public offering. And you, myself, my dad, my mom, anybody can buy shares in these companies because they're publicly traded. All you need is a Robinhood account. All you need is a Fidelity or Schwab account, where you could go on and buy the exact same stocks that Matt and I have helped put into the portfolio for St. Louis, right? So that is a publicly traded market. And what I would say is, for us, well, I will say this, the private equity side of the business, you've got some funds that they call crossovers. They do a little bit of both, but mostly if you were in private equity investments, you've hired a manager, you've given that manager funds that they're using to buy companies that have not gone through the process to go public. And what you hope that private equity group does is they buy that. Now they own that software company. They own that chemical manufacturing company, whatever it might be. It could be in any industry. And they go in and they potentially make changes, make it more efficient, they make it more productive, you would hope. They put in a management team that they have confidence in, and then they own that. It's not traded on the stock market, but they own it 3, 4, 5, 6 years, and then ultimately look to exit at a much higher premium than what they paid on your behalf for that company. And they put a collection of those companies together. So we're operating in very different lanes, but what we're trying to do in both cases, I keep bringing up quality, is find that quality. good companies, good managed companies, good earning streams, durable earnings that they think that they can continue to use to outperform. Those would be kind of the two different ways you could approach the market, and I'm sure you do have within your portfolio. Now, I forget, Jeff, there was another part of your question as well. Just in terms of
Yeah, no, that's helpful. And I think the rest of that is again just sort of bridging the gap. So there's the Russell 2000, which is the area that you focus on. Are there publicly traded, coming again, something that we can go on Robinhood and invest in that are smaller than the Russell 2000?
Yeah.
Is that a market that's out there, and is that something that folks look at?
Yeah. So thank you. So yes, you could say, I don't want to be with Westfield. I want to hire, just give me the small cap market. If you saw on that previous slide, there were 1,000 stocks within the Russell 2000 growth benchmark. In your portfolio, we have 72 stocks, right? So we are not owning the majority of that index for you, right? And why that is important is because when the market has been kind of up and to the right since the global financial crisis of 2008, by and large. And if you look at, we're not going to jump forward, I'm sure you've looked at our performance. We have consistently outperformed on an annualized basis point, the benchmark, by 350 basis points. So you've been able to appreciate, you've got that appreciation of investing in Westfield much more than had you just put this in what we call a passive index fund. Basically, there's funds that replicate that Russell 2000 growth and those 1,000 stocks. And why that's so important is you've got managers with skill, like Westfield, we believe, that you've hired, that we can outperform regardless of these market. And so you would have left so much money on the table by not hiring a manager at Westfield. But I think what any active manager in this seat would tell you is that it's been over the last 15 years, even before you invested in Westfield, basically what's happened is the market's gone up and to the right and everybody's benefited because of that appreciation. But really, where an active manager kind of makes their bones is when the market turns. And typically managers like Westfield, and I'm sure managers that Mariner has helped put into your portfolio for you, are focused on that quality, that when the market is down 5, 6, 7%, 10%, a lot of the stocks, because of those quality underpinnings, they tend to do a lot better than those other, call it 930 stocks that are in the index. Or not all of them. Some of them we will miss, admittedly, no questions asked. But all of those kind of biotech names that I don't want to hold my nose and own this thing, and it's a coin flip and they don't get the safety approval and they go down 75%. Our hope is we keep you away from some of that stuff because of our active management approach.
And so along those, like, can you again, just for the benefit of the group on this active manager concept in general, in your opinion, is there a better opportunity for outperforming benchmarks in small cap relative to a large cap manager? Give us your general thoughts on that.
I can take that part. I think in general, yeah, I would agree with that statement. There's a lot more alpha potential in terms of magnitude of moves in the small cap area. I mean, if you find an unbelievable small cap stock, you're not playing for 20, 30% returns. You're playing for something that could go up 3 to 5x over a few years. That's a lot harder to find further up market cap. The only other thing I would say is, now if you look at the large cap composition, almost all of the returns, I would even say all of the returns, have been driven by that Mag 7, the Google, Apples of the world, Nvidia, that Justin had referenced earlier. And so to the extent that those names sort of start to fizzle out, it'll almost be easy to beat a benchmark in the large cap space, because everything else underneath, where we could express more active bets, should in theory outperform that group if it fizzles out. But in a year where Mag 7 goes straight up, it's more challenging to beat a large cap bench. But in terms of magnitude of moves, like it's hard to find as much alpha as you can in the small cap space.
Justin and Matt Squeld, I'm sorry I joined late. I had some problems with my video, but can you discuss with the group why wouldn't we just put a large chunk in small cap? Let's talk about volatility, et cetera, and why you would not put all of your portfolio, the equity portfolio, in a small cap type
Yeah,
of.
we talked a little bit, thanks, Gwilda. We talked a little bit up front and just in terms of their small caps tend to be less liquid in terms of the number of shares that are offered than some of the large cap trillion-dollar market cap companies we talked about, like Apple and Google. So when you have a thinner traded stock, you've got fewer shares that are exchanged on a daily basis, right? That any one big institutional buyer, let's say Matt comes to the table and says, I really love this oncology company for healthcare within St. Louis's portfolio. And if you think about Westfield right now is running we have about 4.5 billion invested in the small cap strategy. So if Matt wants to exercise a 1% position in our portfolios, those are going to be a lot of shares that we're going to try to buy over the course of, call it, a week, right? Depending on how much shares are exchanged daily in that stock. But we have to be very sensitive that because we want to buy this one healthcare stock, we don't artificially move the price of that stock because there's just fewer shares. So they are more volatile. You could get a big institutional buyer like Westfield or anybody that you might have investments in. You could get index those. We just talked a moment ago about how you could buy an index fund through Vanguard. There are a lot of ways you could buy an index fund, the S&P 500, the Spider. If those make moves in and out of that could shift the price quite a bit in small cap stocks that just one buy from Westfield is not going to move the price of Apple or Google. It's just too many shares outstanding for that to matter. So to your point of, okay, if you've got $100 for St. Louis, and I'm making it up, you wouldn't want to put, even though the upside potential can be, like Matt said, can be huge. You're not saying, okay, let's put 30% in small cap. I would say, I mean, that's really a Mariner, but that just seems like too much risk in the small cap space when you've got stocks that move around a lot more. But over time, we believe, over time, small caps have been a very good investment, and we think they are really coming into their own right now. And again, I would have said this each of the last 5 years, and I would have been dead wrong. The shift from large cap to small caps has started to happen. It happened at the end of the summer, and we think it's going to continue to happen. But you do live a little bit more with the roller coaster in small caps.
I would also just add where you're invested in the Westfield small cap portfolio, it's not like you're invested in, 5 or 6 stocks that, at any given point in time, small cap stocks can be volatile. You bring up a very good point, but we're pretty diversified in the portfolio, just in terms of number of names. It's usually 60 plus names. So you're kind of diversified from a name count perspective, but we're also investing in all sectors, right? So there are times when healthcare and biotech are really hot and you're getting that exposure through my names. And then there are times like in the past year or so when the AI data center trade has been really hot and we are getting a lot of exposure to that through Ted Richardson's coverage of industrials. And so I think we're pretty diversified from both the sector and a name count, and that should help reduce short-term volatility.
And I will also say this, and this speaks to, I wanted to mention this, Jeff, when you asked about private equity versus public. One of the trends, and I say this too because we go back so long with St. Louis to the year 2000. When you first invested with us, there was probably double the amount of companies that were publicly traded in the market. Because private equity has grown so much as an industry, right, or as a asset allocation for investors like yourself, you've had a lot of companies that normally would have gone public, they would have done an IPO, that stayed private longer. And so that had been the trend really from 2008 up until COVID. And then in 2020, you saw a lot of companies, especially in small cap, start to come out and come IPO. And what that meant was that was good for the markets because it fed more capital into the markets. But at the same time, it provided a lot, I hate to say it, but less quality for active managers like Westfield to pass over, to say, okay, a lot of these companies probably shouldn't have gone public. They're going to be in the benchmark. We're not going to own them, but that's going to hopefully be good for our clients when you look at our relative returns. It is amazing that all of this discussion we're talking about in terms of active management and quality and all this, I'm actually, it's great we could do this because when we talk about your performance in 2024, it directly correlates to that. And I'm happy to jump in that now. I want to be cognizant of time. Are there any other questions about maybe the small cap space? We could take you through why we're so optimistic about that. That actually starts on page 6. Or we could jump right into your portfolio. I don't know what would be the best use of time.
Let me just go ahead and go
I
through
think
this.
it'd be good to hear a couple
Yeah.
seconds on just on the opportunity and
Yeah.
why we want to be there. So
Okay. No, I love it. So this is the 4 quadrants. I mean, of why we think small caps are poised to lead. And I mentioned a moment ago, we've been calling for it for a long time. Large caps have outperformed small caps. When you look at not our performance, that whole index that we talked about, benchmarks, if you looked at in the growth space at the large cap growth versus the small cap for 10 years, it's been 9 of the past 10 years, even last year. Large caps outperformed small caps. And it was like Matt said, it was driven largely because of that Mag 7 group of stocks. Now, the valuations, you can get small caps at such a historic discount right now than you can relative to large caps. That's reason number 1, right? And then reason number 2, we do believe you're going to see an earnings inflection, and we have started to see that within small caps. Small caps don't work unless the earnings story is there. And the projections for small cap earnings are incredibly strong this year and should be very strong this year. Big things are definitely happening. But I can say all these things. You could talk about the fact I didn't even put it on this page, but small caps are much more US focused than a lot of the multinationals that are in large cap. And if you still have a lot of geopolitical unrest across the globe, which we do have, then small caps will be a little bit more insulated. They're a little bit more insulated from some of the tariff noise that we saw much of 2025. And a lot of those tariffs, if you look at large cap companies, if the companies have been able to pass that through in pricing, is just starting to flow through. You probably get a lot less of that in small cap. But the reality of it is, and Matt's sector is a lot of the same way, rates mean so much. And if rates come in, you're going to see small caps continue to do very well. Now, Washington is it's impossible to analyze, right? We're not trying to handicap what happens with Washington. You get one tweet, the market goes bonkers, right? But it sure does seem that Washington wants rates lower, right? And so if that continues to happen, that could definitely benefit small caps. And then the reallocation math. So let's go through these pages. Just a small shift from that group of Mag 7, it would be like a tsunami effect. It would raise all boats in a good way. I shouldn't say that about, but in a good way where you would have a 5% reallocation from the Mag 7 lifts the index by 25%. And that's just the top 5. You do all Mag 7, you're close to 35, 40%. So you just need a little to come out. Now, this seems dated because this has happened, right? This year, to start the year, all 7 Mag 7 stocks are in negative territory. And oh, by the way, large caps are negative. Your portfolio is up almost 9% in small cap. So you are starting to see a 10 percentage point delta this year to start 2026 from small caps to large cap.
In the index, I mean, it's a great point. It's early in the year, but even just looking at the indices, so that the benchmarks, it's probably about a 800 basis point swing. So we're doing better than the bench, but I can't recall a time in recent history when there's been this much of a spread and small caps have outperformed large by so much, and it honestly feels like it's the first inning.
Yep. And all the pages support that. I mean, the one you could take a look at, if you could just go through a page, page 8 shows the earnings. This is the projections going into 2020. That was the valuation discount on this page 7. And then page 8, where we had to look at this page and these earnings like 5 times. It just looks fake. It doesn't even look real. But these are projections of projected earnings for the Russell 2000. So this is the core benchmark, but shows small cap earnings are projected to accelerate first quarter, second, third, into third quarter for this year. That would be incredibly conducive. The next page really just shows that impact of this is 5 of the Mag 7. Doesn't even include Tesla or Google or Alphabet, which is split into 2. But Nvidia, Microsoft, Apple, Amazon, this is playing out. A small reallocation. Now, I'm not saying these are fantastic companies, right? This is not 2000 all over again when you had all this .com mania and all of these stocks that they had no earnings, they had no revenue. People were trading these stocks on quote unquote eyeballs, who was on these stocks. There wasn't much behind those companies. And you saw so many of those companies didn't make it. This is totally different. Nvidia, Microsoft, I mean, these are phenomenal companies in America, and they're going to be phenomenal companies. You just need a slight reallocation to lift all small cap boats. And then the next page, the one thing I would say too, and we could talk about why we're so optimistic. The next two pages talk about both math sector and industrials. So this was printed a few months back, and I will say this has shifted because we've been in an industrial recession for the past 3 years. And the ISM print about 3 weeks ago, 2.5 weeks ago, for the first time in 3 years was well over 50. So it was just music to our industrials analyst ears. If you get an industrial push, it's going to be incredibly beneficial for St. Louis because the way that we invest in your portfolio is both cyclical and secular growth. And all that means is those companies in the secular, which maybe a software company or software has gotten absolutely destroyed over the course of the last few months, but those companies that have huge total addressable markets and kind of grow irrespective of the market environment, we have that in the portfolio. But then on the other side of the barbell, we have these cyclically sensitive stocks, which you typically find in industrials, materials, energy, financials, so that those companies are shorter cycles. When the cycles turn and happen quickly, those companies tend to provide ballast in the portfolio when the market turns. So again, your portfolio looks really good on a long-term basis in terms of it's up, 12%, I think, annualized over and well over the benchmark. But we've had an up and to the right market for a long time. Where Westfield was hired by so many folks like yourself was our ability to protect capital when the market turns, right? We can't lose that money for you because it's so important for all your constituents. So that quality that we keep talking about is so important into the portfolios. Now, with the whatever 15 minutes we have left, let's talk about last year. So if you scroll all the way, the reason why this whole quality story is important, right? So let's go all the way to page. We won't go through process and the team, but instead, if you scroll to first just to 29, page 29 is just a reminder of kind of the relationship. So if you keep going forward, as I mentioned, and we can spend time on whatever you prefer, but as I mentioned, you funded the account June 28, 2000. And basically the market value right now we're up 27 million. But then on the right-hand side of the page, you're not asking us to do anything we wouldn't normally do within the portfolio. You go to the next page, actually, scroll down. Here's your performance relative to the index. So like we said, on the left-hand side, the shorter term performance had a good fourth quarter, but 2025, we underperformed relative to the benchmark. So that was last year. The universe ranks, we're still in the top 35th percentile relative to all small cap managers, pretty consistently across the board. But the longer term numbers look really, really strong. And this year, like Matt said, we're off to a fantastic start, up 8.5%, benchmarks up 4.5%. So, about 400 basis points plus of relative returns. So your question is, why did you underperform last year? If you go to the next page, you can see this is kind of tells the whole story. So again, we've been calling for the small cap pivot. And once we saw it, if you look in the top chart, top left-hand chart, what that line is Westfield's performance over the benchmark from the start of the year. So take Jan 1, 2025, you see our excess return. And for the whole year, we were basically above the line. We were outperforming on your behalf. Well, in August, that whole trend of small caps starting to outperform large cap happened. It was kind of Christmas Day. It was like, oh my God, this is happening. This is good it should be good for the market. And now I don't think we were surprised that when that first turn happens, the things that tend to lead are the things that have been beaten down the most in the index, the quote unquote lower quality stocks, the stocks that I don't think St. Louis would want Westfield invested in for a 5-10 year period. Right. It was things that didn't have much earnings behind it, were very risky, were very volatile, but they went crazy high. Now that is indicative of the playbook that happens. I think that didn't surprise us. I think what did surprise us was the magnitude of how high those low quality stocks ran. That was quite a bit. But then what happens is usually when that happens, 6-8 weeks later, the dust settles and quality starts to lead. So if you look at that top chart, that low quality trade, you saw it bottomed at the end of September. And then we clawed our way all the way back, almost close to the index in the fourth quarter. Really good fourth quarter, almost to the index for the year. And as we talked about, off to a terrific start here in 2026. It continued into this year, which has been encouraging. But then if you go to the next page, so then why do we think that you're in really good shape with Westfield going forward? We went back and looked at a very similar environment where low quality stocks did very well on a shorter cycle of a pivot from large caps to small cap, and that was right at in the height of COVID. So if you look at this chart at the end of 2020, right into kind of this time, middle of February of that year, 2021, we had that same low quality rally, and Westfield underperformed considerably. But the next 9 months, we were 13% higher than the index. This is all on the left-hand side of this chart. Now, scroll forward to what we just saw, right? The August to October timeframe, really. September, July, August to October. Very similar spike in that high momentum, volatility, low quality, right? And so what we're saying is we believe we're a coiled spring for excess return going forward. If that period is consistent with what we saw coming out of COVID, which so far seems to be the case, knock wood, things can turn very quickly, but it looks like this is seeming to be the playbook. Sorry, I think somebody had a question. Did somebody have a question? Maybe not. So that's kind of why we're optimistic about what's going forward. If you scroll forward a few more pages, just in terms of how we're right there. So just in terms of how we're positioned on your behalf. So like I said, we really like healthcare, Matt's sector in particular. We really like industrials, and we really like financials. And you can see that on the top chart. So our weights, your weights within the small cap St. Louis portfolio are in the navy blue, and then in the light blue are the benchmark weights. So overweight those three sectors. They soak up a lot of the capital that you've given us. There's 73 stocks in the portfolio, as we talked about. And that weighted average market cap, despite the fact I started the call saying small caps go up to 43 billion, the average size of the companies, we are a true small cap manager, are 10 billion, right? And a lot of that is gotten because the stocks in your portfolio, like a Comfort Systems, which provides the HVAC and cooling for data centers, right? It's kind of getting that tailwind of the AI trade without being a direct in the bullseye beneficiary of AI. It's the picks and shovels of the industry. It's been a fantastic name. It's like the second biggest name in the index right now. But Comfort Systems is another reason why it goes up, and it's a $30-40 billion market cap. And so it's pushing that cap up to 10 billion. So we are above the index, which is a 5 billion market cap. But again, to Matt's point earlier, it speaks to quality.
On that note, you mentioned one stock in particular that had a huge market cap, Bloom Energy. So I know your average weighted market cap is a little bit above now, but typically it's within the range of the index. What is the sell discipline, or do you just let your winners run?
Yeah.
Yeah.
Great question. So in order for us to buy it, it has to be within the range of initial purchase. But let's say they reconstitute the benchmark and a name is doing incredibly well, like Fix, Comfort Systems, and it's getting up higher. You're absolutely right, Gwilda, that we are aware and cognizant of the fact that does this really represent a small cap stock? We want to let the winners run, and we will do that. And that has happened with Comfort Systems. But at some point, we realize we're going to have to sell that stock. But we don't want to do it kind of at the point of a bayonet. We want to be thoughtful about how we do that. We still want the client's best interest in mind. They've been able to generate so much of that return that we want to keep that. But we also realize at some point it has to happen, and we will do that. And oftentimes we'll graduate it up, or it's probably already in our SMID or our MIG. It just graduates up where it's in another strategy at Westfield. But we do want to be true to the mandate that St. Louis hired us for. We're a small cap manager. We don't want Meta or Apple in this portfolio just because we bought it 20 years ago.
Right. The other question is, I think you said there's about 4.5 billion in this particular product. Am I correct?
Yep, that's right.
What is what is the most that you'll hold in this portfolio before you start to see the returns somewhat?
Right. Yep. When do we close the strategy so that we don't hinder investment results for St. Louis? It's the right question. And for us, it's about 6 billion right now based on our analysis. So we've got about 1.5 billion. The way that we generate, what we have is a best execution liquidity committee. And so they look at the numbers monthly, they meet quarterly, and that takes into account a lot of different things. Number of holdings, days to trade on our portfolio,
Mhm.
how thinly traded are some of the stocks that we currently have. Then we look at what are the market conditions? Is there liquidity in the market? We look at VWAP. We have a third-party GTA Babelfish that we've hired to help assess kind of that market impact of if we had to liquidate the entire portfolio, how long would it take over the course of a 3-day period, 5-day period? And I will tell you right now, we could liquidate almost the entire portfolio within 3 days. I think there's 2 names that would take, a little bit more, obviously, because they're a little thinly traded. But right now, the conditions are conducive enough that we think 6 billion. You could ask me that in 6 months. We could have fewer names. It could change.
Okay.
But we are thoughtful of that. Like, we totally get it. Like, we never want Matt to say, I love this biotech company, but if we put a 1% position, we can't do it. We won't get close to that because there's not enough shares to go around. And so we never want that to happen.
Thank you.
Yeah. All right. Any other questions, Matt? Did I leave anything out? I don't want to take up any time.
I think you covered most of it.
Anything else that might be helpful for St. Louis or just in general? Our market outlook is like a lot of things we already talked about. I mean, we're cautiously optimistic for the market. I think this year it's gone off to a good start. So that could be one of the big concerns, right? It's the small cap stocks are up so much, but you continue to see this broadening out. You continue to see a more conducive rate environment. I think that'll help. Matt brought up another point that we just haven't seen, and that mergers and acquisitions, M&A really starts to take hold. That will put a floor on the valuations of a lot of these small cap companies and will be very, very conducive and very good for the market. We've seen more M&A than we thought we would already. If that continues, that's going to be a really good tell and a really good sign, certainly for the market. Any other questions I might have? I mean, I would just like to say how appreciative we are of the long-term investment. It's always great to talk with clients that have been with us for so long. So we certainly appreciate that, and it's never lost on us too whose money it is we're investing. We know last year was we underperformed, but again, we're working hard to get all that back, and knock on wood, hopefully what we saw in the first few months has been indicative of what we can expect for the remainder of the year.
Are there any questions from the committee?
Oh.
Okay, thank you.
Okay, thanks everybody. It was great seeing everybody.
I thank you all.
Thank you.
Take care.
Thank you.
And I think they're off.
Any discussion, questions from the group?
That was a very good overview.
Good, I'm glad.
Was it helpful the first part of that, at least from an educational standpoint? We're always challenged with the managers because they can't help themselves. They always want to jump in and talk about themselves, but we're trying to be as pointed with them up front to say, listen, let's stick with some education here. So
No, I think it was very good. It was neutral. It wasn't like biased to one side, and it was a good overview of exactly what small cap equity and just what that means and what that means in modern day time. So very good.
Good. Are you ready for us to move forward?
Yeah, I think so.
Yeah,
Okay.
rock and roll.
Okay, well, I'm going to start off, and Sue, if you could bring up the quarterly report. This is really old news, so I'm not going to go through it in depth, but I will hit on a few pages. If you'll turn to page 13, the two pie charts.
Okay.
You know what? Go back one, Sue. I'm sorry. Go back one. Always want to comment on the asset allocation. Okay, on this page, as you all know, who've been on the committee, and for those who have not been seen this page before, this page is the asset allocation chart where we have the ranges. The gray bars represent the minimum and maximum range of each segment of the portfolio. And as long as a little inverted black triangle is within that gray bar, that means that you are more likely to attain the return that we put together for this portfolio. So as of December, end of December, all of these segments are within their range. We're a little bit over on cash, but that comes down with capital calls as well as benefit payments. Move forward to the next page, Sue. This is a pie chart basically showing different segments in different colors. And you've got the market value of the fund as of the end of September, which was about $905 million. And as you can see, a nice pickup in gain. And as of December 31st, $933.6 million to end the year 2025. The next couple pages are just your fee schedule. If you'll turn to page 15, Sue, this is the, we ask all the managers to, with the exception of the privates, to have a goal in different segments as far as MWDBE brokerage commission. And as you can see here, with the exception of Systematic, which is a value manager, all of the managers in domestic equity have exceeded the goal of 33% of the trades going to MWDBE. In international, Causeway has exceeded their goal, which is 10% more than doubled it. Ernest Partners in fixed income, well above the 10% at 44. And in global equity, Exponents at 19, above the goal of 10%. So we will have discussions with Systematic and see what's going on there. Sue, if you could turn to page number 18. Okay, at the bottom of this page, you see the gray bar at the very bottom that shows you the roll up of the cash flows for the quarter ending December 31. As you can see, the market value we just discussed as the beginning, get contributions of about $34.2 million, distributions out of about $26 million, management fees of $236,795, other expenses $57,485. Nice capital gains or increase in market value of about $20.6 million. And that's how you come up with the ending market value of $933,607,512. Let's see if we can move forward to page 26. This gets to the meat of the matter. Okay, here's the returns of the fund over the fourth quarter of the year. As you can see here, the composite return was 2.3 above the policy index, which is just policy index is basically passive management allocated like your fund is allocated. So you exceeded what you would have gotten if you'd had passive management throughout the portfolio. And not only that, you ranked better than almost 80% of the other funds in your space, public funds, ranking 22nd. So what you want to see over is to see that number in that below 50. As you can see, somewhat not quite as strong over the past year versus the benchmark, nor ranking versus the peers. 3 years, 5 years, you're right in line with the benchmark. And since inception, you are ahead of the benchmark and you rank better than the other half of the public fund universe. And what I'd like to point out here, with the exception of that rolling 5-year period, the fund has exceeded the actual assumption rate of 7%, which is what you need to make sure that you meet all of the benefit payments of the people within the plan. If you look down this page, you can see the different segments and how they've done for the quarter as well as over time. And as you can see here, total domestic equity, you've exceeded the benchmark. Large cap, pretty much in line. Large cap core, large cap value, you've exceeded the benchmark. You have an active manager and a passive manager there. You can see here, this is where we get into the active management. Edgar Lomax is your active large cap value manager. That manager has just had some difficulties. Some of the longer term periods this quarter did very well at 5.64 versus the index at 3.81 and ranked 13th. Over the past year, they actually have done well and ranked 23rd and delivered returns of 19.3 versus 15.91. Very long term, this manager has not been as strong as a lot of other managers in this space, but they've exceeded their benchmark by 6 basis points. One of the reasons why we peeled off a portion of this manager's portfolio was to give you some of the returns of the value index over time, as well as having an active manager there for when the index doesn't do quite as well. The next page, Sue, we go into some other of your managers for the quarter. As you can see here, we did the same thing here in large cap growth. TCW is your large cap growth manager. We have some concerns there with TCW. As you can see, they underperformed the benchmark for the quarter, and they've had difficulty long term. Part of that is the concentration of the large cap growth benchmark, but Jeff and I have discussed it, and we're noodling over whether we need to move more into the large cap index or if we should look for another large cap growth manager. We'll continue to look at this manager. I know that their stock selection and concentration, lack of concentration in some of the segments in the fourth quarter actually hurt them pretty much. But we are keeping an eye on TCW in that large cap growth space. Westfield, you've heard from, as you can see here, that manager, as mentioned in their presentation, has actually done very well. They just had a little bit of a blip, as they discussed, in the third quarter of last year, which is that 1 year return, which is slightly below the Russell 2000 growth. But in all other time periods measured, that manager has done well versus the index and has been above the 50th percentile or just right at it, right within 1 or 2 percentage points of it on a long-term basis. Systematic is your small cap value manager. They're the offset for your growth manager in the small cap space. And as you can see here, Systematic has done a great job for the quarter, delivering returns above the benchmark at 4.34 versus 3.26 and ranked 18th. They also had some underperformance in the 1 year period. But if you look at the long-term numbers for Systematic, they have done very well. And in all periods measured, they're well above the 50th percentile in the small cap value manager space. DFA is micro cap, which is even further down the capitalization spectrum. It has delivered returns in the quarter 42nd and above the benchmark. The year and 3 year time period is a little weaker, but if you look at this manager long term since 1993, so they've been with you longer than even Westfield, that manager has delivered returns in excess of their benchmark and ranked above the median in their peer group. Now we move away from the domestic managers and we go to international. Total Development International as a segment delivered really good returns in the fourth quarter of the year. That whole segment delivered a return of 5.67 and ranked 23rd. If you had a chance to look at the report prior to the meeting, International did extremely well and it delivered returns as a group, as a segment of the market over 30%. And that had been an area in the equity markets that had underperformed domestic markets for a long time. So we've seen a nice rebound in international, some of that due to the currency effect with the dollar weakening. But here you've got a developed growth manager, Fidelity, delivered returns of 3.36 versus 1.86 for their custom benchmark and ranked 23rd. And you look across the board here for Fidelity, and that manager has exceeded its benchmark in all time periods measured. Causeway is the flip side of Fidelity in a developed value manager, and they were right in line, just slightly 2 basis points below their benchmark, but ranking 22nd, doing very well versus other developed international value managers. A little bit more difficulty in the 1-year period, but the long-term numbers for Causeway, they've done very well, exceeded their benchmark as well as ranked above the median in their peer group long-term. You can turn to the next page, Sue. Emerging markets. This is another area of the market that did really well in the fourth quarter and last year. As you can see, your DFA is your emerging markets manager, and they exceeded the return of the MSCI Emerging Markets Index with 5.1% return versus 4.73, ranking 43rd. Some weakness, but still delivering a return of 30% over the past year. The long-term numbers for this manager, as most of your other managers have shown, have exceeded their respective benchmarks in all time periods measured, with the exception of the 1-year rolling time period, but very good returns for the emerging markets manager. Exponence is a manager of managers, and this quarter they have underperformed, bringing 2.1 versus 3.3. As you can see here, they have seen some difficulties in the past 3 rolling years and 5-year period for this manager. The long-term return, they were hired in 2020, 11.64 versus 12.64. We can reach out to Exponence because that is a manager of managers to see which of the managers in their portfolio have actually been the laggards. But we'll continue to watch Exponence over time. Turning to the next page, Sue, we go into fixed income. As you can see here, fixed income, the total fixed income, which encompasses all of your fixed managers, both core as opportunistic. You can see here a nice return for the quarter, 1.1 versus 0.35 for the custom benchmark. If you drill down here, you've got 3 managers in the core space: Manulife, Ernest Partners, and Loop. Manulife, as you can see here, has done well in every time period measured and delivered in excess of the Bloomberg aggregate and ranked well. Ernest Partners, you see the same pattern there. Loop was just hired last year, just slightly below for the quarter, but since they were hired last July, have delivered returns at above the Bloomberg aggregate at 3.8 versus 3.17 and ranked very well, doing better than 93% of the other managers at 7th in their peer group. Was there a question? I thought I heard somebody. Okay. And then if you go down to opportunistic fixed income, you've got Loomis, who did well in the quarter, 1.63 versus the benchmark at 0.35 and ranking 10th, doing better than 90% of the managers in that peer group. The year-to-date return is good. 3-year return, 5 years, and since inception, they've been with you since 2017. The next one is a passive benchmark. That's the TIPS portion of our Treasury Inflation Protection securities. Neuberger Berman is an opportunistic global manager. As you can see here, they actually have rebounded. They did have a bit of difficulty in the 5-year rolling time period, but as you can see, in the last year, they have come back. And you can see here in the 3-year, the 1-year, and the quarter, they've actually started to rebound. So we're happy to see that the opportunistic manager is able to pull out, and they have exceeded their custom benchmark in that 1-year, the quarter, and 3-year rolling time period. Now, Wellington Multi-Sector, they were just hired in November of last year. And as a result, you don't have a quarterly number, you have a partial number here, but since inception, which was so basically a 2-month return, as you can see in that far right column, they've exceeded their benchmark for the 2-month time period, 0.93 versus 0.55, and ranking 26th. You can go to the next page, Sue. Okay, you've got a global tactical asset allocation manager. We had some concerns about PIMCO All Asset Fund. As you can see here, they're starting to rebound. The quarter number, that 2.85 versus 2.01, ranking 36th. In that, between that 1 and 3 year time period, you saw there were some difficulties. If you look at the longer periods now, in the 5 year rolling, they're right at their benchmark, but the longer term numbers have come up with the more recent performance. And as you can see here now, that manager is exceeding their custom benchmark in the 10-year and the since inception time period. And then you have the hedge fund managers. Entrust is basically paying out or pretty much done. But you can see here, both Whitebox and Grosvenor exceeded their respective benchmarks in the fourth quarter of the year. Over the past year, Grosvenor was the better performer. As you can see here, 16.7 versus 10.6. Whitebox, about 13 basis points below their benchmark. But the long-term numbers, the since inception numbers for both of these managers, they've exceeded their respective benchmarks long-term and have delivered good results for the plan. And the next page, I believe, is real estate. As you know, that we had at one point pulled the, had put in a redemption request for UBS on both of these funds, but we have rescinded that request. And as a result, and what has proved out well for us, this market real estate is starting to rebound. And as you can see here for the quarter, both the property fund and the property income fund both exceeded the NCREIF in the fourth quarter of the year and ranked well versus peers. The Trumbull Property Fund ranked 26 with a return of 1.35 versus 0.68, and the Property Income Fund 1.32 versus 0.68. And you can see over the past year, both of these funds have done well, exceeded the benchmark, and ranked really well. These more recent returns are pulling up some of the longer term numbers. And as you can see here, the Property Income Fund actually since inception has actually exceeded that NCREIF at 7.7% versus 5.76. And then you have quite a few private investments, and the internal rate of return for that portfolio, which includes private equity, private debt, actually is about 10.5% internal rate of return for that segment of your portfolio. Any questions on the performance of the managers or concerns before we go to the your page regarding watch lists? Okay, if not, Sue, page 82.
No way.
Okay. Edgar Lomax, as you can see here, as we mentioned, we had moved some money out of Edgar Lomax, but they still have not come green in all the periods. The 5 year rolling now, as you can see, they have met the criteria, but they're still in the penalty box of being in the watch list. We talked about TCW, and we'll be having continued conversations with the committee regarding TCW and how we're going to handle that. So they are on watch. Westfield just had that one time period, but in all other time periods, they're doing fine. DFA had one bad time period, but they don't qualify for watch. Exponents, as I mentioned during my discussion, because of the lack of returns versus their benchmark or underperformance versus the benchmark, they are now in the watch list box, and we'll have conversations with them. The Neuberger Berman had been in the penalty box. As you can see in the most recent time period, they have done better, but we need to see continued outperformance over time to get them off of the watch list. PIMCO All Asset have been having troubles, but now we're seeing that they have passed one of the criteria. So yes, they are still on watch, but we'll continue to watch them for continued improvement to come out of the watch list for the plan. Are there any questions on any of the managers or a discussion? And Jeff, please weigh in if there's something you'd like to add to what I've already said.
Nope, that was excellent.
Thank you. If there's
Yeah,
nothing else.
I would only just like to comment. I think this slide is just very helpful. It just shows the monitoring, you know, and the intentionality behind things. So appreciate it.
You're welcome. I will turn it over to Jeff to bring you up to date on what happened in January.
Great.
And Jeff, didn't we, wasn't there something about TCW there, management change or something?
Yeah, and that's just another kind of item to add to, because again, remember this watch list here is purely quantitative, and so we always want to keep an eye on those factors, but something that doesn't always get reflected in this type of chart are organizational issues. And so again, we will always make recommendations to this committee that if we see something, you know, even if the performance is really good and doesn't make this watch list, if there's some sort of organizational change, we will always bring that up to the committee and recommend a manager potentially be placed on watch for organizational issues or for an investment strategy change. So it just so happens here that TCW already on watch for performance, and now we have some management changes as well. So that just kind of heightens the scrutiny a little bit more. And I guess you know, sneak preview, and as we transition over to the January report, I'll give us a little bit of a sneak preview of some things that we're probably going to want to talk about in March. So Sue, if you want to flip to the page 2 of the January report, and again, this will look familiar to everyone.
Yeah. Okay. Which is,
Okay, so this is the asset allocation page. Gwelda walked you through this page at the end of 12/31, and at the end of January, not much different, but I did want to spend a couple seconds on this just to talk about a few items that might stick out a little bit. And one is you see the cash allocation. That's the bottom bar. That is that triangle sort of at the high end of that range. And there's a couple reasons behind that. One is there's about $20 million in that will be going to the manager that you all selected in the international equity space to replace that emerging market manager that we had. So that's Ernest Partners International. So they'll be getting that part of that money. And then the other portion of that is just money that Sue will be using over the next couple of months for benefit payments and expenses. Now, as part of all that, and this is wrapping kind of a bunch of things into one here, but at the March meeting, we will want to talk about rebalancing. So Sue is going to need another sizable chunk of money over the coming year for more benefit payments and expenses. So we always have to come up with a game plan as to where to get that. So we will have a roadmap to that says this is how we rebalance the portfolio. This is how we keep things in check. We'll walk through that, but in that process, we're going to see a couple things happen. Number one, addressing a few of those managers that have been on the watch list are going to be a focus for some of the things that we're doing on rebalancing. So again, we'll walk everybody through that. Also with this international equity manager, Ernest, versus what we had in emerging markets, we will want to address a policy change. So something next time we go through an investment policy rewrite, we'll want to rethink, because right now you see if you go down a few lines on that table at the bottom where we have total developed international equity, and you see our target is 11%. And if you look at the bars up top too, you see, we're kind of ahead of that benchmark. We're still in compliance with the policy, but we are ahead of that. because of that shift that we now have from emerging markets to more full international equity, we'll want to address that target. So we would, at some point when we look at the policy rewrite, we'll want to think about a 13% target allocation to the developed international, and then conversely, the emerging markets where that's at 4%, we would want to bring that target down to 2%, because that's sort of the level we're going to be operating at. Also, Gwelda and I are looking at some allocations and things, particularly in that large cap growth space, and potentially changing that target, flip-flopping the target right now from what we have between TCW, the active manager, and then the passive manager. So right now we have a higher target to the active manager relative to the passive. We might want to look at flip-flopping that. So it's going to be kind of a minor change, but again, something that's within the investment policy. The other moving piece that's going on here, then this is always a moving target. You look at our real estate, private equity, and private debt allocations, and you see our private equity is actually a little bit over. If you go back historically, it's been maybe a little bit under or right on. We've had a bit of a flurry of activity between some of the new managers that have been calling capital, and maybe a little bit of a slowdown in some of the capital coming back from other managers. So another report that we're going to be sharing with the group over the next couple of meetings is what we call a pacing report. And that just basically tells us, how, because private equity, we know that it's not as easy as just buying and getting into a mutual fund and getting it out of a mutual fund. They're private investments, they don't always take capital, and we know that it comes back in lumps too. So we always have to make some estimates as to when we think capital is going to get called, when we think some of that's going to come back from our current managers, and how that keeps us in check with a target. So that's what our pacing does. It's always there's a lot of there's a lot of art and maybe a little bit of science behind how that works. But we'll walk you through the report again, and really what it does ultimately is just tells us, next year, how many searches do we want to do? Do we need to have searches? Again, we've had quite a few, but within the private equity space, private debt. So just, based on what these allocations tell us in pacing, means we probably don't have to prioritize a new private equity search anytime soon. So something we'll probably start thinking about for, maybe early next year. And then private debt, we had another allocation that was approved there. So as some of those start to get called, that moves closer to the target. But again, within our pacing, we will evaluate to what extent we will have a search sooner than later in that. So it might be nice if we're in a position to take a little bit of pause, because we know we've had kind of a flurry of activity and have thrown a lot of new managers in front of everybody. So it will be good to be able to, what we just did with Westfield, to be able to have some meetings where we have some of these private managers come in and again do a similar thing. Tell us that here's what private debt is, and here from a very straightforward educational level, and this is the strategy and what it does, and try to take away their specifics to what they're actually doing and what they're actually trying to sell everybody out there. So again, if we can just get a little bit more educational on those spaces, because we do understand there's been a flurry of activity and some new committee members and trustees on this board too. So if we can, it would be nice if we can take a little bit of a pause there. So the pacing will tell us that. And again, those are all future things coming up over the next couple of meetings, and again we'll go into it in more detail, but it's a little bit of a sneak preview of some things that we will be addressing on the overall asset allocation and manager front. I'll pause there. I know that was a mouthful. Any questions? Okay, and we're running out of time, but I will be quick with the rest of this because it's all positive, and sort of following on what Gwelda talked about in her report. Other than some things that have been on watch, we don't have any major recommendations that we would make with respect to any of the managers today. So Sue, if you want to flip forward to the first performance page. And I'll just hit on everything here at a high level. So you can see January was a nice month. So a continuation of the good results that we had in 2025 and in that fourth quarter. So a lot of the themes that we saw at the end of 2025 have continued into this year. So more accommodation from the Federal Reserve. And when I say accommodation, that just means they're trying to keep interest rates low so consumers still have an incentive to go out and spend and can borrow money, and companies can do the same thing, things that help the economy. So that has worked, and we've seen good things from companies that have been able to operate with lower debt, or if they're going to take out debt, do it by paying lower interest. Companies still continuing to get some pretty good earnings. The one thing that we have started to see, and at the risk of jumping around, sorry, Sue, if we want to jump back 2 pages to that, to our market overview, and this will just explain a little bit more of what Westfield was talking about also. If you take a look at that top left chart and the year-to-date section and what they were talking about as far as things that start to reverse in trends and what happens in the market. So we've had all of these big AI names and this Magnificent Seven that everybody's talked about. Well, everyone's starting to pay attention to how expensive those are now, and they're reallocating. They're starting to sell some of those names. And so when you see that Russell 1000 growth, that's the only one that sticks out in that chart as being negative, because that's really driven by a lot of those names. So money is starting to flow into those other segments of the markets. If you take a look at the 1-year period, what's been really noticeable too is now those bottom 2 lines of that chart, the EFA and that EM, that's the emerging markets. So those are both the non-US markets. Those are areas that have been out of favor for quite a while, and now we're seeing money rotate there. And much like the folks from Westfield said, if you look at that Russell Midcap Index for the past year, and then the Russell 2000 starting to have some pretty good returns. And so again, expectations, we probably start to see things flow back in that direction. So Sue, if you want to go back to the performance page again, and I'm going to wrap up really quick here, as I know we're right up against time here. So again, a nice accretive month. And what does that do for our latest 1-year period? Puts us just right about 14%. So not far off of our policy benchmark. Again, Gwilda talked a little bit about the items that have been causing those deviations. But if you look at that 5-year number, and a lot of that 5-year number now is starting to be indicative of a lot of the restructuring that we've done over the past couple of years to tighten things up, to get rid of those excess risks that we've had in the portfolio that we're not getting paid for, and again, just focusing on areas of the market that are either going to be lower cost for us, or going to help us be more like an index, or have a better probability of outperforming indices. That 5-year number starting to play out for us, and the 5 and 10-year number and the inception you see on the page. Again, as Gwilda mentioned, these are going to be above what we're targeting from an actuarial expectation. That 5-year number probably pretty indicative. If we were to run an asset allocation study today that looked forward 5, 10, 20, 30, 40 years and said, what do we expect this particular asset allocation to generate for us? That 5-year number is probably going to be right in that ballpark. So again, really, really keeping up with expectations in this structure. So I'll pause there and see if there's any questions. Well, great. And if not, that unless there's any other items, that concludes our report.
I think we did need to talk about the March meeting and what the trustees would want to do about that. So the March meeting is March 19th. So I kind of looked at, what spring break looked like for everybody, and folks that are in schools, all of those schools had their spring break that week. So I guess, the question is, you want to just go ahead and have that investment committee meeting that week, March 19th. Jeff and Gwilda are both available the next week, which is the 26th. So what is the pleasure of the group on what to do about the March investment committee meeting? We've got a couple of good things we've got to talk about at that meeting.
Well, Sue, either of those dates work for me. So I can do the 19th, which is during spring break, but I can do that, or the 26th. If so, either date works for me.
I'm open to both as well.
Our spring break is the same week as everybody else's. I don't have any plans at this moment, so either week is fine.
Okay. So I guess if there's no conflicts, then we can just keep it
The
on
19th
the 19th. if
was the
that's-
spring break.
Yeah, spring break that week, but if everybody is, I guess if somebody has a conflict, let me know, but it sounds like we'd be okay on the 19th,
Okay.
which is the regular meeting.
Just thinking a lot of them might be out of town, but nobody said anything, so we'll go
Yeah.
with it.
Okay. So I don't think we had anything else on the agenda.
Okay,
Thank you all.
excellent report.
Thanks.
Thanks, everybody. Hope everybody has a good weekend.
Yeah.
Thank you.
Yeah,
Okay, have a good one.
we need to do a formal end to the meeting before we close. We need a motion to adjourn.
I motion to adjourn our investment committee meeting.
Second.
All in favor?
Aye.
Opposed? Any abstentions? Is that it? So we don't have to do a roll call? Okay, well, thank you all so much.
Thank you.
Thanks, everybody.
Thank you.
Bye, have a good weekend.
Bye.
Good night. I can talk now. Bye.
Okay, so. About this place, so I don't know if you like, wow.
Oh,
Susan, before you log off, I
Yeah.
didn't get any of my information.
okay. So we mailed it last week.
Yeah, well, it didn't come, but it's okay.